Cryptocurrency has taken the world by storm, especially during the last few years. The total value of all these digital currencies has swelled to more than $2 trillion, says Bloomberg. Of these, Bitcoin is the most popular, worth more than $1 trillion itself, according to CoinMarketCap.com. Investors have swarmed to this digital gold rush, often with little knowledge and a lot of hope. Cryptocurrency's rapid appreciation has many investors questioning the place of stocks in their portfolios. But there are numerous differences between stocks and cryptocurrencies. Should you invest in cryptocurrency or stocks? Any savvy investor needs to know exactly what they're investing in. It's crucial to weigh the risks and rewards of investing, and what will drive the investment's success. If they don't have this kind of information, they can't make the calculation. In this case, it's not really investing, it's much more like gambling. Here are the key things investors need to know about stocks and cryptocurrency. In this video, we are going to evaluate whether it is worth investing in crypto or stocks based on these factors. Risks and safety. Time horizon. Portfolio management. We start by analyzing the stocks. What is a stock? A stock is a fractional ownership interest in a business. It's easy to lose sight of this if you become overwhelmed by the wiggling stock prices and the potential for profit. As a legal ownership stake in the business, the stock gives shareholders a claim on the assets and cash flow of the business. Why stocks rise and fall? A stock price moves as investors assess the future success of the company. While investors may become overly optimistic about the stock in the short term, the stock price ultimately depends on the company's ability to grow its profits over the long term. Risks and safety. If you're considering investing, you need to carefully consider your risk tolerance. Can you handle the volatility of -50, -60, or -70% of what you have invested? How well do you respond to gains and losses in your investments? Learn about your risk appetite before making any investment. Stocks are an ownership interest in a company, so a stock's performance over the long term depends on the underlying company's success. If investors don't like a stock, they can sell it and push down the price, but ultimately the company has to go out of business for the stock to be worthless. Volatility is high with stocks, and many stocks can rise 100% or more in a year, and may fall just as quickly. The stock market is an established way to invest with a strong track record, generally. Investors who don't want to buy individual stocks can own funds such as those based on the Standard & Poor's 500, which has gained 10% per year on average over time. Time horizon. Your time horizon, when you need the money from an investment, is a key criterion. The shorter your timeline, the safer your asset should be, so that it's there when you need it. The more volatile an asset, the less suited it is for those with a short timeline. Stocks are often volatile, but they tend to be less volatile than crypto. Individual stocks are more volatile than a portfolio of stocks, which tends to benefit from diversification. The stocks are better suited to investors who can leave their money alone and don't need to access it. Generally, the longer you can leave it invested, the better. Some stocks can be more volatile than others. For example, growth stocks tend to fluctuate much more than value stocks or dividend stocks. Investors may shift from more aggressive stocks, growth stocks, to safer ones, dividend stocks, as they need to tap their money, such as when they approach retirement. Portfolio management. As you're thinking about constructing your portfolio, it's about weighting your portfolio in a way that fits your risk and time horizon. Given stocks' strong long-term record, a diversified collection of stocks should make up the majority of your portfolio, especially if you have decades until you need to tap it. If you're investing in individual stocks, you'll need to research your stocks carefully to achieve good returns. If you're investing in funds, you can buy a broadly diversified fund, such as an S&P 500 index fund, without significant research and enjoy the potential for high returns. Now let's analyze crypto. What is a crypto? Generally, cryptocurrency is backed by no hard assets, specialized stablecoins being an exception. And that's the case for the most popular crypto coins such as Bitcoin and Ethereum. A cryptocurrency may allow you to perform certain functions, such as sending money to another person or using smart contracts that automatically execute after specific conditions are met. Why cryptocurrency rises and falls? Because cryptocurrency is not backed by assets or cash flow, The only thing moving crypto prices is speculation driven by sentiment. As sentiment changes, prices shift, sometimes drastically. So cryptocurrency is driven only by the hope that someone will buy it for more in the future. What's called the greater fool theory of investing. For a cryptocurrency to be a successful investment, you must get someone to buy it from you for more than you paid for it. That is, the market must be more optimistic about it than you are. Risks and safety. If you're considering investing, you need to carefully consider your risk tolerance. Can you handle the volatility of -50, -60, or -70% of what you have invested? How well do you respond to gains and losses in your investments? Learn about your risk appetite before making any investment. Since cryptocurrency is generally not backed by assets or cash flow, it relies only on sentiment becoming more favorable to push up its price. If traders decide they don't want to own a cryptocurrency, it could plunge to zero because it's not backed by anything. Volatility is particularly drastic here, with cryptos rising or falling 50% or more in a year commonplace. Countries could ban cryptocurrencies entirely, as China did in 2021. Because it's relatively new, cryptocurrency is not yet firmly established as an asset class. As risky as stocks can be, cryptocurrencies are even more speculative. Time horizon. Your time horizon, when you need the money from an investment, is a key criterion. The shorter your timeline, the safer your asset should be, so that it's there when you need it. The more volatile an asset, the less suited it is for those with a short timeline. While stocks are volatile, cryptocurrency is ridiculously volatile. For example, during 2021, Bitcoin lost more than half its value in a few months and later gained 100%. Such volatility makes crypto unsuited for short-term investors. Crypto is better suited to traders who can leave their money tied up and wait for it to recover. Think years rather than weeks. Portfolio management. As you're thinking about constructing your portfolio, it's about weighting your portfolio in a way that fits your risk and time horizon. Given its inherent risks, cryptocurrency works better with a small allocation in your overall portfolio. Think 5% or less. Even a small allocation could do wonders for your portfolio if cryptocurrency really takes off. Also, limiting to a small allocation protects you against a complete loss if crypto goes nowhere. If crypto grows to be a significant portion of your portfolio, you can reallocate more of your money to stocks to lower your portfolio's overall risk. After this explanation, what do you prefer to invest in, crypto or stocks? Let me know in the comments. If you enjoyed this video, make sure to hit that like button. Also subscribe to our channel before you go. Thank you for watching.